Hi all, welcome back to Commerce Veda. I was not able to post few videos because of tax season. Since last 2 weeks, I didn't post any video. So I'm back today to post a video on a topic called hire purchase. This chapter is very important for CMA Inter and BCom MCom students. Now, before going into the chapter, we should understand what is hire purchase, and especially for heavy vehicles. Say suppose a lorry. Assume a lorry is costing 75 lakhs. You have two options to buy. One is in cash, full payment. Second one is in hire purchase system, payment in installments. It doesn't mean it is installment purchase. Installment purchase generally applicable to consumer goods, whereas hire purchase applicable to goods such as cars, lorries, trucks, cranes. Heavy goods. Hire purchase applicable. Now, what exactly is this a transaction? This is an agreement between the buyer also called as hirer, and the vendor also called as hire vendor. Agreement between the buyer and the hire vendor. We use the words hirer and hire vendor. Hirer means the person who is purchasing the asset. Hire vendor means the person who is selling the asset under the hire purchase system. The agreement between the buyer and the vendor to buy the asset at an agreed price in certain number of installments. Now, these installments includes price towards cost and interest. So, it is an agreement between two parties, and one party agrees to buy the asset from the other party. The first party is called hirer, who is buying, and the other party is called hire vendor, who is selling, to buy the asset at an agreed price in number of installments. Like, you don't pay immediately, you will pay in installments during a particular period. Now, and the installment includes what? Cost and interest. Why? Because why interest? We'll see here. Say today, I say 20th September 2025, I went to a shop and purchased a heavy vehicle for 75 lakhs. I went and purchased and I paid. It means the seller received the money immediately. And second person also approached the seller to buy the asset, but not in cash. In say around 10 installments, half yearly. 10 installments, half yearly. It means what? Almost 5 years. So, the price charged to me is called cash price. Why? Because I am buying this immediately. It is the cash price. And the price charged to him can't be 75 lakhs because it should be 75 lakhs plus interest. Interest for deferred payment. deferred payment because he is paying in 5 years time. So he's taking 5 years time to make the payment. So the price can't be 75 lakhs because today I'll get 75 lakhs is different. And after 5 years I'll be getting 75 lakhs installment is different. So the vendor always wants to add interest to this money. Right. So there are two important price concepts we should learn here. Number one is cash price. This is for immediate purchase, immediate payment in cash. And the other one is hire purchase price. This is for deferred payment. And this includes cash price plus interest. So cash price plus interest. So we can say hire purchase price equals to cash price plus interest, or interest equals to hire purchase price minus cash price minus cash price. So these are the two prices, and we know this price is always more. Why? Because you are making the payment for a longer term in installments. So definitely the vendor will charge interest, and this price is always less. Why? Because you are making the payment immediately. So there are two prices. For cash customers, you will give cash price. For hire purchase customers, that will be hire purchase price. This is a basic thing we should understand. Now, what exactly hire purchase transaction, how it happens? This transaction happens in three parts. Number one is first down payment, second regular installments, and third final payment. This is on signing, and this is during the tenure, and this is on what? Termination of the agreement. Right. So this is on the first day. When you enter into the agreement, you have to pay some signing amount, down payment, and after that, out of the tenure, you have to pay interest plus cost called EMIs, or we can say installments, which includes cost and interest during the tenure of the hire purchase agreement. And finally, at the end of the tenure, you have to make a final payment. Then what is the importance of this final payment? That is very, very important to understand. Right. Number one, what happens as per the agreement? Asset comes to hirer. Hirer here means hire purchaser. But ownership is still with hire vendor. Ownership is still with hire vendor. Why? Because installments is not paid. Ownership transfers on payment of last installment. So suppose if I purchase a vehicle, a lorry, for 75 lakhs, 10 half yearly installments, right, on payment of 10th installment, I will get the title of the asset. But what happens on payment of signing amount? The possession transferred to hirer. Possession will be immediately on payment of signing amount, but only after payment of the final installment the ownership or the title get transferred. It means what? At any time during the period, the stock or the goods or the asset can be repossessed by hire vendor only if the conditions of agreement were not met. Like you fail to pay the installment, right? Or you fail to keep the asset in good condition, because owner is the seller. You are only the user. You have the possession, but the ownership is still with the seller. So the seller has a right to repossess. See, what is the meaning of repossess? On signing, possession transferred to hirer, possession transferred. On repossession, possession comes back to hire vendor. So I'm taking back. That's why I'm calling it as repossession. Repossess the goods. For the buyer it is asset, but for the vendor it is stock, because I'm selling my goods. For me, like suppose say the car showroom, cars are goods, but for me car is an asset. I'm buying the asset because I'm using it for my business purpose, but for them car is a stock. They're selling it, stock in trade. That is not their fixed asset, it is a stock in trade. So they call it as repossessed stock. I call it as asset repossessed by the vendor. So the basic understanding here is the parties. Who are the parties? Number one is hirer, means purchaser of the asset on hire purchase basis. Then one is hire vendor, seller of the asset on hire purchase basis. Then hire purchase agreement, which contains cash price, number of installments, price of each installment. We can say not price, we can say amount of each installment, and a rate of interest. Right. Due date of installment, repossession clause, and last date of installment to transfer the asset, to transfer the title. So many other clauses, but accountancy we need these things. What is the cash price? How many number of installments? Amount of each installment, rate of interest called as ROI, date of installment like due date, what is the date installment should be paid, and when it can be repossessed, how to calculate. I can say this clause contains calculation of repossession value, calculation of repossession value. All the terms and conditions shall be in the agreement. So these three are very, very important before we actually step into and understand the hire purchase chapter. Now take a small example here how it works. It can work in many other ways. The first way, as always, say suppose cash price take 20 lakhs, right? Date of purchase, take it as 1st April 25, right? Number of installments, say I can say 12 installments. Frequency, say quarterly. It means per annum 4 installments. Due on end of each quarter. Rate of interest 12% per annum on the outstanding balance. Right? So we know 12 installments and quarterly payment. How do we compute the amount of installment is very, very important thing here. So this data is clear. Now what we can do here is I'll write year 1 only. I'll do now. Year 1 you have first installment, second installment, third installment and fourth installment. And one more important word here is down payment, say 20%. Down payment 20% and balance in 12 installments equally. Equally in the sense cost price equally, not the total installment value. How it is will compute. So if you see this here, year 1, installment 1, installment 2, installment 3, first year 4 installment. How do we compute these installments? I should know first cash price. Cash price 20 lakhs less. Down payment is also called as signing amount. It is also called as on signing the agreement. So it says 20% means 4 lakhs. So balance 16 lakhs and number of installments 12. So value of each installment, we should see the value of each installments is 1,33,333 rupees. This is the value of each installment. Now, first year, if I make first installment on 30th June 25, because at the end of each quarter, date is 1/4/25 and is 30th June 25. How much I should pay? 1,33,333 plus interest on 16 lakhs, because on the date 16 lakhs is due, into 12% and for 3 months. I should pay only for 3 months. So 16 lakhs into 12% by 12 into 3 is 48,000 is the interest. So 16 lakhs into 12% into 3 by 12. So the total amount to be paid on first installment is 1,81,000. Now when it comes to second installment, principal is seen 133,333. However, the interest will change here. How it will change? I'll show it here. Opening due 16 lakhs minus first principal paid 133,333 principal paid. So the balance is 146, 14,66,667 is the balance on second installment. On that second installment, I have to pay 12% for 3 months. The interest is 44,000. How I did? 14 lakhs 66,667 into 12% for 3 months. So 44,000. You are paying an installment of 177,333. And the third installment, which is on, this is on 30th 6 and this is on 30th 6, this is on 30th September, this is on 31st December, and this is on 31st March. Every 3 months, every quarter. Now here comes third installment, principal remains the same. The interest is minus second installment 133,333. So 14,66,667 minus 133,333 is 13,33,334. This is the due balance. For third installment, the balance principal is 13,33,334. On that, you are paying 12% for 3 months. It is 40,000. So your total installment value is 1,73,333. See here, number of installments. This is value of installment of cash price, and this is cash price plus interest. For every installment, we are adding interest back, because we have given cash price, we have given interest, and we were told that you compute interest on the installments. And the fourth installment, same the cash price 133,333, and if you remove third installment here 133,333, is 12 lakhs 13,33,334 minus 133,333 is 12 lakhs. Okay, 1 rupee because of rounding off. So the interest on 12 lakhs for 12% and 3 months is 36,000. So making this 36,000 plus 133,333 is 169,333. Similarly, you have to compute the same pattern for 12 months, because it is 3 years, 12 installments quarterly. This was the first year. What we did is we identified first installment is 181, second installment is 177, 181,333. Second installment 177,333. Third 173,333. Fourth 169,333. Similarly, I can actually compute for full also like this. If the question wants to compute all the 12 months, what we can do, we write installments 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. I can write due, first installment due is 16 lakhs. Interest at 12% and total we'll say here principal and total principal and then total installment and balance. Very simply, 16 interest here is how much? 16 lakhs into 12% into 3 by 12, 48,000. And principal 133,333. How you got principal? 16 lakhs by 12. And total is 181,333. And the balance, principal minus principal. Balance is due minus principal. 16 lakhs minus 133,333. 14,66,667. Now, second installment due is 14,66,667. You are computing interest at 12% into 3 by 12 because quarterly 44,000. Principal remains the same and total 177,333. So 114,66,667 minus 133,333 is 13 lakhs 33,334 and third year opening due 13,33,334. On that interest is 12% into 3 by 12, 40,000. Principal remains the same and the interest is the total EMI 173,333. And if you remove 13,33,334 minus 17,333, it is 12 lakhs 1 rupee. That should be the fourth installments and the interest on that is 36,000. This remains the same principal and the total is 169,333 and 12 lakhs minus the principal 133,333 is 10 lakh 66,667. That should be the opening. On that again the interest 32,000. Principal remains the same. So the total is 165,333 and 1066,667 minus 133,333 is 1066,667 minus 133,333 is your 933,334. That should be their opening. On that interest at 12% for 3 months is 28,000 and you have to pay the principal of same principal due. So it will be 161,333. Now you remove this from your principal outstanding. It will be 8 lakhs at the end of year 2 or beginning of at the beginning of your 4th, and then 1, 2, 3, 4, 5, 6, 7th installment is again how much it is? 8 lakhs due, and on 8 lakhs you have to compute interest, which is 24,000. Principal remains the same, so it will be 177,333. So 8 lakhs minus 133,333 is your 666,667. That should be your opening. On that, interest will be 20,000, and this remains same, and total is 161. This is 157, 160, 133,333 plus 24. Yeah, then it is 133,333 plus 20, 153,333. And when you remove this principal, the principal due will become 533,333. That will be your 9th installment opening. Interest 16,000 and principal remains the same, and the total will be 149,333 you have to pay. And now from 53,333 you remove 133,333, you'll get 4 lakhs as your principal outstanding, and that is the principal outstanding at the beginning. So the 4 lakhs on the 4 lakhs you are again paying interest, which is 12,000. 4 lakhs into 12% into 3 by 12, 12,000. Principal remains the same, so it will be 145,333, and from 4 lakhs you remove the principal, it will be 266,667. That is the opening of 11th installment, 266,667. On that you compute interest, it will be 8,000. 266,667 into 12% into 3 by 12. So, and your principal remains the same, adding it to 141,333, and the balance is 133,334, and the principal is 133,333. I'm rounding it to 333, and this is 4,000, and 133,333 full principal paid, so that it will be 137,333, and outstanding is 0. So this is the way the total works. Now we need to see what exactly I repaid. If I add all my principal payment, my total principal payment is 133,333 into 12 months, coming to 16 lakhs. And if I see what is this is my cash price, total cash price, 166, right? I paid 166, and if I add the interest, what is the interest I paid? 48,000 plus 44,000 plus 40,000 plus 36,000 plus 32,000 plus 28,000 plus 24,000 plus 20,000 plus 16,000 plus 12,000 plus 8,000 plus 4,000. You paid total interest of 3,12,000, and if you see the total hire purchase price towards the total how much you paid, 312 plus 16 is 1912000. Now if you add down payment not to here, you should add down payment to cost price, because on down payment no interest, because you paid on the same date. So your total cash price is 20 lakhs and your hire purchase price is 23 lakhs 12,000. This is cash price. This is hire purchase price, and the difference between these two, 3,12,000, is your interest. So calculation requires this. You should know your due. How you got the due is your total cash price 20 lakhs and your down payment 4 lakhs, that is 20%. So cash price due is 16 lakhs. This 16 lakhs you are paying in how many installments? 12 installments, 1 to 12. How do we compute interest? We should compute interest quarterly. First 16 lakhs, I computed interest at 12% per annum for 3 months. For 3 months to get 48,000, and principal is equally over all the period. So I'm adding interest plus principal, I get my installment amount. So if I add all the installments, it is 19 lakhs 12,000. If I add all the interest, it is 3 lakh 12,000. 1912 minus 312 is my total cash price due paid. And if I add my down payment to the cash price, I get total cash price. If I add the down payment to the hire purchase price, it is total hire purchase price. So the difference between hire purchase price and cash price is my interest. This is how the transaction should happen if you are given cash price and interest and installments and wanted you to compute the interest portion. This is all about the first basics of hire purchase accounting. Now, before accounting for it, we understood the computation, and this computation is in detail, clear. So every year, how do I account this is also important, right? Same problem if you can account it for first 4 installments, first year, how it goes, we'll see. So the first year is 1/4/25, right? First year is financial year 25-26. 1/4. 1/4, what I did, I purchased the asset. I'm writing in the books of hirer, purchaser. In the books of purchaser. There are 2 methods: interest suspense account method, normal method. I am now doing the normal method for the first year only. So 1/4/25, if I purchased, like I purchased my machinery, right? First thing what I did is I purchased the machinery by paying down payment, right? By paying down payment. But before that, asset should be in my books for 20 lakhs. That is the asset, because possession transferred. Though I am not the legal owner, I am the beneficial owner. I am using the truck, I am using the lorry, I am using the asset in my business. So account says whether you are a legal owner or not, but you are the beneficial owner, you should record the transaction as your asset. Though I am not the legal owner, I should record the asset in my books as asset. So what shall I record here is machine. I should write hire purchase asset. Name of the asset you can write whatever it is. 20 lakhs cash price. To whom I should pay? Hire vendor. 20 lakhs. I'll write being asset purchased on hire purchase. So I purchased the asset on hire purchase. So I should write hire purchase asset to hire vendor 20 lakhs. immediately on the same day I'm making down payment. To whom I'm making the down payment? To the vendor. So hire vendor account debit to bank. 4 lakhs I'm paying. So I'll write being down payment paid. I paid the down payment. Now comes the next transaction is due entry. Assuming I'm not defaulting, I'm paying everything. So the due entry comes on 30th 6/25. End of the first quarter. Quarter is April, May, June. 1st April to 30th June. So 30th June is my first installment due. I'll write here installment due, right? What is, first of all, I should write interest. Interest is due. Installments are already here. 20 lakhs minus 4 lakhs, 16 lakhs due is already there. Credit 20, debit 4. So how much money due to the vendor? 16 lakhs in your books as a credit payable. Right, you credited hire vendor for 20 lakhs, you debited for 4 lakhs. In your books, the credit is already appearing at 16 lakhs. The principal amount is due. Now, interest you should accrue on the date. So, what is interest? We call it as finance charges account debit 48,000. That is interest. You can use the word finance charge or you can use the word interest. Interest is nothing but finance charge. Interest. To whom you should pay? Hire vendor 48,000. We'll write being interest due. Now interest due, principal due, both are due. How much you are paying on the same date? Hire vendor account debit 48 plus principal is 133,333. So 1,81,333. If you go back here, this is the first installment you pay. This is interest, principal, total amount paid. So coming back to the entry, you should write to bank 181,333. Narration is being first installment paid. Same year, right? Same year. So immediately next due is 30th 9. Repeated entry. Finance charges debit 44,000 interest. To whom you should pay? Hire vendor 44,000. Same narration being interest due on second installment. Right. And on the same date, you are paying 44,000 plus 133,333 principal. So hire vendor account debit 177,333 to bank 177,333. All right, being second installment paid. 2 installments done, but year ends on 4th installment. Now go ahead and repeat the same exercise on 31/12/25. Same finance charge account debit of 40,000. Where I am getting these figures? See here, 48, 44, 40, and this is constant. Second installment, third installment. Now we are doing it right. Now again going back to whom I should pay? Hire vendor 40,000. What is the narration? Being interest due on third installment, and immediately I should post other entry, hire vendor account debit. How much? 40,000 plus 133,333. 173,333 to bank 173,333, and the last installment for the year. After that end of the year, there are a few more entries that we should discuss. So that is 31st March 26 next year, because December 25, then Jan 26, Feb 26, March 26. So again, here I should write the B, third installment paid. Then 31st March 26 is finance charge account debit 36,000 to hire vendor 36,000 being interest due on fourth installment, and on the same date I write the payment entry, hire vendor account. See here, hire vendor in the exam, if it says Hero Motor Car, then you replace hire vendor with Hero Motor Car, and hire person X, you should write X is the hirer in their books. So hire vendor here means the party from whom you are buying. So if examination the question they give a name to the vendor, should use the name of the vendor, right? Hire vendor to bank, which is 36,000 plus 133, 169,333. With this, year 1 closed, but finally on the same date we should do two important things. Number one, compute depreciation on the asset. Assume the asset is at life, only 4 years life you take, because you are closing in 4 years. Suppose if you are taking 4 years life, the asset with zero scrap value. So I'll write here depreciation account debit to hire purchase asset account. 20 lakhs is my, I'll do this here, 20 lakhs is my value cash price by 4 years. Life I'm assuming only 4 years. If it is only 4 years, 5 lakhs is my depreciation. Assuming no scrap value and on the asset and straight line basis. For understanding, we should compute depreciation at the end of first year and write being depreciation charged on straight line basis for 4 years. Right. After that, same date, 31/3/26, you should transfer all the expense to P&L. The first expense is finance charges and the second expense is depreciation. The finance charge is how much? 48,000 plus 44,000 plus 40,000 plus 36,000. Total finance charge is 1,68,000. Check here. 36, 40, 44 and 48. So 48, 44, 48 plus 44 plus 40 plus 36,168, and depreciation is 5 lakhs. Total debit to P&L is 6 lakhs 68,000. We should write being interest and depreciation charged to P&L. With this, first 4 installments are completed, and same thing will be repeated every year from installment from this particular entry till this particular entry. It will be repeated every year. Interest due, installment paid. Interest due, installment paid. Interest due, installment paid. Fourth again, interest due, installment paid. And finally, depreciation, and then transfer of depreciation and interest to P&L. Now, this we can also see the example by an account. I am preparing two important accounts here. First account is hire vendor account, and second account is hire purchase asset account. It's for the first year. Only for the first year I am preparing. Now vendor, if you see, it shows on 1/4/25 buy hire purchase asset, which is 20 lakhs. And the same day to bank down payment you paid, which is 4 lakhs. And then on 30th/6 by interest, by finance charge, you added 48,000 by finance charge. And on the same 30th/6 to bank you paid 48,000 plus 133,333 is 181,333. And on 30th September you again paid interest 44 in due interest, and on the same day you paid bank 44,000 plus 133,333, 177,333. And on 31st December also finance charge you are due 40,000, and same day you paid that, which is 40,000 plus 133,333, 173,333. And on 31st March also interest due 36,000, and you made the payment on the same day to bank 36,000 plus 169, 169,333. So if you see the total at the end of the year, what is outstanding from this guy is 20 lakhs plus 48,000 plus 44,000 plus 40,000 plus 36,000, 21 lakhs 68,000 on the credit side. And how much you paid? 4 lakhs minus 181,333 minus 177,333 minus 173,333 minus 169,333. So the balance is 31,326. To balance carried down is 10,66,668. If you see at the end of fourth installment, if you go back and check your calculation, at the end of fourth installment your balance is 10,66,667. Coming back, Your balance exactly at the end of fourth installment is 10,666,668. This is the accounting for vendor first year. This is year 1. And asset, if I say, as you purchase the asset to hire vendor 20 lakhs on 1/4/25 and on 31/3/26 by depreciation 5 lakhs and the same day 31/3/26 by balance carried down 15 lakhs. So 20 lakhs is the value of the asset at the end of the year. This is how we should actually learn the basic things. What we did here is we computed the interest for all the 12 months, a detailed interest, and we passed the entries for first year. We can repeat the same for the second year and we can repeat the same for the third year. Once this payment is made, then hire vendor should become 0, and at the end of fourth year the value of the asset also will become 0 because you depreciated full. So this is how the basics of hire purchase goes on. I'll start with a sum from your textbook to help you out in how to solve the problems. However, we also need to learn how do I enter these in the books of the hire vendor. Right, same first year. Year 1 journal entries in the books of hire vendor. For the vendor it is a sale because he sold. It is not the asset for him. For him it is stock. So on 1/4/25 what he'll write? He'll write it as receivable from whom? Hirer. Hirer debit the gift, debit the receiver. 20 lakhs to sales. For him it is sales. 20 lakhs being assets sold on hire purchase. I can write hire purchase sale. Better for distincting between hire purchase sale and cash sale, will write hire purchase sale because this won't be recovered immediately. It will be recovered in 4 years. Right. And same day he also got bank account debit 4 lakhs to hirer. He paid down payment, right? So being down payment received, being down payment received, and on 30th/6 interest for him is income receivable. Who should pay? Hirer account debit to interest income, which is how much? 48,000. In your books you write interest expense to hire purchaser, sorry, hire vendor. In this book it is hirer receivable, he should pay you. To income, income should be credit. Their finance charge debit, here income credit. Being interest receivable on first installment. On first installment. Who should pay you? The hirer. What is that? Income. For you it is income. And when you receive on the same date, bank account debit 48,000 interest plus 133,333 principal 181,333. Who paid you? hirer, being amount due on first installment received. Similarly, the same second installment. What will she say? Hirer account debit 44,000 to interest income 44,000. Again, what will write? Being interest receivable on second installment. Interest receivable on second installment. And on receipt, bank account debit, which is 44,000 plus 133,333, 177,333. To who paid you? Hirer. And you'll write being amount due on second installment as received. And then 31, 12, 25. Repeated entry. Hirer account debit 40,000 to, I can write interest income, or I also can write finance income. Both are same. Being interest receivable on third installment, and on receipt of third installment you will write bank account debit to hirer account, which is 173,333. What you will write? Being amount due on third installment received. And finally, the fourth installment 31,326. Again, you will write hirer account debit 36,000 for interest to interest income 36,000. You'll write being interest receivable on fourth installment, and on receipt you'll write bank account debit 133,333 plus 36,000, 169,333. To who paid you? Hirer 169,333. You will write your being amount due on fourth installment received. And you are not the owner of the asset, so no depreciation in your books. So what you can do here is, at the end of the year, your income must be transferred to P&L. So it is interest income account debit, total 48 plus 44 plus 40 plus 36, 1,68,000 to profit and loss account, 1,68,000. You'll write your being interest income transfer to P&L. Only transfer to P&L, no depreciation, because you are not the owner. Though you are the legal owner, but the beneficial owner is the hirer, and the asset already recorded in the books of the hirer, he claimed the depreciation. So similarly, what you can do is, you can only prepare one account here Interest account anyway you can prepare, but important account is hirer. Hirer. So what you should write? Receivable, right? To hire purchase sale 20 lakhs, by bank 4 lakhs. What date? 1/4/25. And then every time receivable 30/6/25 to interest income. How much? 48,000. By bank same date 30/6 181,333, right? And 30/9 to interest income 44,000. Yeah, there it is. By charge payable, there expense to vendor in the books of hire, it is by charge. Here it is to receivable. Payable we credited, receivable we are debiting. That's the comparison. Interest income, and then same 30/9 by bank 177,333, and again 31/12 to interest income 40, same 31/12 by bank 173,333. (31/3/26) to interest income account 36,000. By bank, how much? 169,333. So done. What we can do here is total it. Your total is 21,68,000. Same. And same date by balance carried down is 10,66,667. Check it out. 2168 minus 4 lakhs minus 181,333 minus 177,333 minus 173,333 minus 169,333 is 1066,668. So here it is debit balance, right? And here it is credit balance, exactly matched with your workings. At the end of fourth installment, it is 10,66,667. So this is the process of accounting for hire purchase in the books of hirer and in the books of hire purchaser. And the important concepts to be remembered are what? Who is the hirer? The guy who purchased the asset on hire purchase basis. Who is the hire vendor? The seller who sells the asset on hire purchase basis. What is the cash price? The price paid immediately. What is the hire purchase price? Cash price plus interest. See, it is here. Cash price plus interest. And what is interest? Hire purchase price minus cash price. So this is all the brief about, not even brief, details about hire purchase accounting. What is hire purchase system? So with this, I'll close the session today. We'll be doing some from ICAA textbook, small examples on hire purchase accounting. Hope you understood. Thank you.